Testing, testing, testing. Okay. So, where are we on this one? Okay. And then is this atoms? Okay. So these two will be atoms then. So that's done. That's good. That's for you, Mr. Lane. That's what you get when you do talk to text.
All right, guys, we're going to get started here in just a minute. Feel free to chat in if you guys have any questions. By the way, this is the Mastermind, so welcome. And let's see. Awesome. Thanks, Brad. Good to see you back, man. I feel like I haven't heard from you in a while. All right, let's go ahead and get started, guys. So first thing, I hope you guys are enjoying the advanced channel. If you have yet to request access, let me know, and I'll get you access. So those of you that have requested access, you have access to TPG, and you may not see the advanced option under channels. That's where we moved the 3-pointer, the classic, and the gray dagger. I'll be adding more to that channel. I'm speculating that I'll probably add a lot more to this channel than I will the TPG channel, just because these are not 90+%. But we're starting a new series this week, today. It's just best practices, and so we're going to talk about best practices of trading in general, best practices of trading with alerts, and best practices of analyzing indicators. So I want to take it into those 3 parts. I don't know that we'll be able to wrap that all up in 3 sessions, but we're definitely going to try. All right, they will be recorded, and they're only going to be accessible to Mastermind members. So, all right, Brad, let me do that really quickly. Actually, now that I've got you here. There you are, my friend. You've been added. Shoulder surgery, man, that's rough. That's one of my biggest fears. Being in a wheelchair and having to have shoulder surgery. I have friends that had to have shoulder surgery, and it puts them out. They can't wheel themselves around. They got to get into a power chair. Man, it'll be a cold day in hell if I'm ever in a power chair, man. It's not my cup of tea. I need to be able to be mobile and get around and not have to have somebody help me get in and out of a vehicle. I drive for myself, and I don't like to be limited by anything. So man, I don't envy you, man. It's painful stuff, regardless of whether you're in a chair or not. So yeah, that's tough, man. Glad to hear that. Sounds like it went well. I'm assuming. Hopefully your recovery is going well. But for those of you that have noticed the advanced channel, hopefully you're utilizing that. Obviously, we kind of prefaced. So this says the patterns herein are those that do not have a 90% or greater accuracy within the Forex market. These patterns are for advanced proving ground members to use with discretion and other disciplines within the market. So part of the best practices, right, and we're going to talk about that not today, but we'll talk about what some of those best practices are when trading the alerts as well. The 90+% proving ground patterns are still going to be in the TPG channel. If at any point you guys want to mute a channel,
You can do that within your application or on your desktop. You can access Slack on your desktop as well. And if you want to mute a channel, like some of you guys might have the light channel, that's just redundancy. So mute it, because anything you get in the light channel, you'll get in TPG or advanced. Light, actually everything you'll get in light, with the exception of the classic, will be in TPG. The classic will now be in advanced. So just keep that in mind. All right. One thing I wanted to show you, another thing I want to show you guys is under the flashcards tab within daytradesmart.com. At the bottom, I now have added other resources. So once you've successfully opened each document, copy, paste into a separate Excel or Google Sheets document and save on your computer. Please do not attempt to modify the document provided through the link. It will not save your edits. So if you click on these, you'll see that it'll bring up within Google Docs the trading checklist, and then an example of some stuff. Obviously, this is where you check your checklist, and then here's some percentages so you can use on the fly if you don't have the calculator up right away. So you'll just basically copy and then paste it into a new Google Docs or into an Excel document, and that way you can save it however you'd like on your computer or in the cloud using Google Docs. If you don't have Google Docs, something else, or if you use open source sheets or whatever it may be, feel free to utilize this. So I wanted to post this for you guys because I'd mentioned I was going to add it, and I hadn't had a chance to add it yet. I'll be fixing this. I'm probably going to change it so that it doesn't go to a Google Doc. It'll probably just be a hard file, like an Excel document. My concern is that some of you guys might not have Excel, and so I still want you to be able to access these. Golden ratio template is in here as well. The golden ratio template has this. This is actually a picture because Google Docs doesn't edit the same way. And so I'm hoping that picture copies over. If it doesn't, if you copy and paste and this picture doesn't go with it, just click within the picture and then copy it or jot down the instructions somewhere. And market time difference. A lot of people were asking about this one. This is just something that I created. It's not fancy, but shows the market time difference for UTC within green chart, and then this is offset by Mountain Standard because that's the time zone I'm in. You can change that to your time zone if you want, and then obviously adjust the numbers. So if you're in Eastern, then this is going to be 8 o'clock, and this is going to be, 7 is going to be 9, and 8 is going to be 10, so on and so forth. So 6 is going to be AM leading to noon, 1 is going to be PM leading to midnight, and then back around again. So 1500 is going to be 6 a.m. and 12, or MetaTrader 4 is going to show 1500, which is 6 a.m., and that's going to be 12 on UTC or in green chart. And again, just kind of highlight, copy, and paste, or you can just pull it up here anytime you want to reference it, because it's not something you're going to modify. It's just something you're going to reference to see how the times correlate. Okay, so I'll be adding some other resources there as well, and I'll probably change the way that we access them within this document. If I try to change them, they'll change for me because I'm the author, but you guys can only view them. So if you guys click on them, you're only going to be able to view them. You're not actually going to be able to edit them. Good, I can see some of you guys kind of popping in and checking that out. Awesome. All right. Let's see. Okay. All right, so let's go to our slides here. We're talking about best practices, so disciplines of a professional day trader. So these are just things that, professional day traders, not just in this organization, but in general, practice when executing the market. And then some of these things are specific to our organization where we have indicators and we have a very unique way of approaching the market, which is what allows for us to have that exponential growth faster than any other trader within the industry. But right now we're going to start just from the beginning. These are more general, right? So planning, we talked about this in lesson 1 of what is proper. We discussed proper planning. This is one of the many disciplines emulated by professional day traders. So it's not just us. anyone that you talk to that's a professional day trader that makes money in the markets and that does it for a living and, lives a higher lifestyle as a result of it, they have specific disciplines that they have developed and utilized over the years that help them be successful in the market. Now, fortunately for you guys, we're passing that information straight along. We're not making you work for it over the course of years and years. We want to give it to you right away so you have a solid foundation. So make sure to have a systematic planning process before tackling the markets. So this is systematic planning, meaning this is what I do in my planning process. I use a checklist. I recommend everybody use a checklist of some sort. There are certain things within a checklist you cannot deviate from having. You have to have certain elements of the checklist present. Part of that is your exit so that you can determine your risk associated with your trades. I've had a number of conversations with folks since I've released the What is Proper 5-part series, and as they're going through them, I'm seeing more questions develop. For those of you that watch them live, I know that some of you are going back and watching them again or making notes, and I see questions coming in from you guys. But I have other people that are watching the videos, and as they're going through the videos, they're raising questions. Now, one of the questions that I want to address really quickly before we get into this is with regard to the notion that trading at a 0.1 lot size is all you need in order to basically play conservatively. And the idea here, folks, unless I'm mistaken, is to make money. I don't know if maybe you guys feel differently, but when I started trading, I did it to make money. Later you realize that what you actually want from it could be different because there's more to it than there's more that you're able to do with it than just make money. Money sometimes is that gateway to get what you want if that's what's holding you back mentally. But at first I made money. I worked hours for dollars in what I did prior to that, and I wanted to exchange working dollars for hours or hours, working dollars for hours with something else. And so I put my hours into this, and I realized I could make more dollars in less hours, and that freed up time. Later the goal changed, but nonetheless, we trade in the financial market so we can make dollars, right? So if you're trading at a 0.1 because you want to just be conservative, and that's all you're doing, you're probably not ever going to make a living out of this. And if you're trading at 0.1 and just letting your trades ride, you're definitely not going to make money at this. You're going to fail at some point, and you're never going to get out of your comfort zone in trading at a 0.1. So you're never going to really do anything with this. If the idea is to make a successful trade or not have a loser, sure, go ahead, trade at a 0.1. But if the overall goal is to actually make a profit and move your account up into the right significantly so that you can replace your income or live a higher lifestyle, whatever it may be, then a 0.1 is not going to get you there. I'm not saying to not trade at a 0.1, guys. You definitely want to get your feet wet, especially when you first start trading live, or if you're in a bad spot mentally, but you still want to put in trades. Trading at a 0.1 is not bad, but the 0.1 is not the answer to anything if you can't even afford to trade at a 0.1, first of all, or if you haven't identified the risk associated with the trade. And maybe you shouldn't even be in that trade regardless of even if you could put in a 0.01. But I'll give you an example. I had an example of one member. He said, well, I like to just scalp because I don't, I'm just warming up to the market, so I just want to take 3 to 5 pips, and I only use a 0.1. He says, but I'm still getting in trouble. So I checked him out, and he's got about a 75% win rate. So he should be trading, risking about 0.5% of his account, right? And, he's got a $2,300 account and funded, and I think started with 2,000, so he's grown it by 300, but kind of back and forth, right? Down almost to margining out, and then back up, and then now he's about 300. But he hasn't really gotten very further than that, and he's been doing it for 5 or 6 months, and so it's like, okay, when do I start making profit, like enough that I can actually, spend it, and so I was trying to break things down for him. He says, well, I traded a 0.1, and I'm only going for 3 to 5 pips. So let's take 10 trades at 3 pips, and you're at 75%. That means that 7.5 of those trades are going to be, let's just give them the benefit of the doubt and use a round number just because it's easier. Let's go to 80, even though he's not at 80. 8 out of 10 of those trades are 3 pips. Well, what's 8 times 3? 24, right? So he makes 24 pips. That means that 2 of his trades are losing. Now, unless he's using a 12 pip stop or hedge position, he's losing money. I don't know anybody that uses a 12 pip stop and trades at 80% or even 75%. I know people that trade at like a 60%, 50%. They use less than a 12 pip because they have to. But 75, 80%, you're probably not using a 12 pip. I don't even think there's anybody on this webinar right now that uses a 12 pip stop. So if it's basic math, guys. This is not rocket science. 8 times 3 is 24. 2 times 12 is 24. That means that if you have anything greater than 12, you're losing money. Matter of fact, if you have anything greater than 10, you're losing money. Because what is 2 times 10? 20, right? That leaves you 4 pips. And if you're trading 4 pips at a 0.1, each of those trades costs you about 60 cents, right? Just to push the button costs you 60 cents. So these 4 trades are earning you, or these 4 pips right here are earning you about $4, right? So the difference between here and here is earning you about $4, because 0.1 is $1 per pip, and you got an excess of 4 pips if you traded 2 times 10, which is a 10 pip stop with a 3 pip take profit at 80%. Okay, so you're making 4 pips, right? But 60 times 10 trades is $6. You guys doing the math here? Which is a bigger number? $6. Again, it's elementary. 60 cents per trade, 10 times, 10 trades is $6, unless I'm mistaken, right? Even if I won 80% of those trades at 3 pips, I have 24 pips. And I lost 2 of those trades at 10 pip stop, I have 20 pip loser, which means I have an excess of 4 pips profit. But after I discount my commissions, I actually lost $2. So even at 10, I'm not making money, right? 10 pip stop. So does a 0.1 have anything to do with this math? The only thing it has to do with the math is how much of your account you lost. It does not have anything to do with winning and making successful winning trades and growing your account and becoming a professional day trader. A 0.1 is a ruse, guys. Don't let anybody tell you, oh, just trade at a 0.1, you'll be fine. Just let it draw down, it'll come back. The market always comes back. Well, we know that may be true, but for most of you, if not all of you, I'm sure that there are prices right now that you've seen in the market that we have yet to return to. If you guys were here in 2017, there are prices that we have yet to return to since 2017. And the prices that we're at right now, we haven't seen since 2014. So if you're trading at a 0.1 lot size waiting for the market to come back, are you making dollars? No, you're still waiting for your trade to come back. You're not making any money. Plus, if you consider what the commissions and swaps are, or the swaps are for carrying that trade, if you were in a trade in 2014 and it's now just come back in 2018, 4 years of swaps even at a 0.1 is going to cost you. It's going to cost you regardless. Yeah, you know what, Brent? If you've got market action and it's too much to focus here, I definitely need your focus, man. So pick one or the other. You decide which one's going to be of more value to you right now. The market's always going to be open. This lesson, I guess you can watch the recording later. So don't buy into the ruse that a 0.1 is going to keep you safe. It's not. You may not burn your account, but you're not going to make money. And again, what is the idea? The idea is to make money. And some of you say, well, I'm just going to trade at a 0.1 until I get the hang of it. Well, now you're making a bad habit if getting the hang of it involves letting your trades draw down, beyond something reasonable. Trade a 0.1 like you would trade a 10 lot, a 100 lot. Trade a 0.1 like you would trade if it was 5% of your account. Trade it just as seriously. And then you're going to be able to use a 0.1 to your advantage because you'll compound it and you're not going to stay at a 0.1. After $50, you're going to be at a 0.11. $50 from there, you're going to be at a 0.12, so on and so forth and so on. At least you're going to be growing your account as you're learning, and you're instituting positive disciplines because you're stopping your trade out when you need to. You're hedging your trade when you need to, and you got plenty of room to do so. And there may be other situations with a $2,300 account where the risk is too great, or you can't take the amount of pips to offset the drawdown, right? But the only way you know that is by doing the math first. So don't buy into the notion that a 0.1 lot size is going to keep you safe and make you a successful day trader, because it's garbage. It's a lie. I don't care who says it. I don't care if Kevin Jones Jr. came in right now and said he wouldn't. He would not. But I don't care if he said it. He's lying. Anybody that tells you that is lying. I don't care who it is. And if they have a quarrel with that, have them come talk to me. I'll show them exactly why they're lying, because it's not my opinion. It's math. It's basic, simple math. And I can show you example after example after example of how that doesn't work. Yeah, the market always returns, but I've seen it take 3 years to return. Now that's a long-term trade. Yeah, that's right, Brent. Practice live like you play live. Yep. Yeah, and here's the thing is that if we're waiting for the market to return to, say, the prices that we saw in 2014, for example. So let's look at that. And you think, well, we're not in 2014, we're in 2018. But what if the price that we're seeing right now doesn't come back? What if we shoot up back to where we were in 2014? We don't come back to this price. Look at this. Have we seen this price? 139,937 since 2014. Has the market come back to that price yet? It came back to this price from previous, right? If we go back, we can, well, this chart's not going to go back that far. I don't have it loaded that far. If we go back, perhaps this point returned from a previous point. But look at how long we've come since this point. We're now 1,397 days, 1,392 days later. We still have yet to return. And we went all the way to 3,653.3 pips. Even at a lot size of 1, you burned your account with a $2,500, $2,300 account. You're out of the game. You were out of the game long before that. So who cares if the market always returns? That's not your game plan. If it is, you're not going to do this for a living. Just keep it as a hobby. It's going to be an expensive hobby. Just keep it as a hobby and don't bother with anything else. Play like you play in Vegas. It doesn't matter if it's just a hobby. If the idea is to make money, though, play seriously. Anything above this line right here has not returned. Anything above that line has not returned. If I was in a trade right here, same difference, right? I'd be 2,504.7 pips. That's going to stop you out of a $2,300 account, even at a 0.1, and long before that. And we've come back within 256 points, 256 pips. So is it really relevant that the market returns at those levels? No, not really, because you're not going to hold out for that, nor is that a recipe for success. So forget the whole notion that, well, I'm just going to trade at a 0.1 lot size and I'll be safe. No, you're not safe. You're in as much danger as if you were playing, with the higher lot size. And the danger is that you're not going to make profit. That's where the danger lies. Okay. So make sure to have, let's go back to these slides here. So we talked about planning, or we're talking about planning again today. It's one of the best practices of professional day traders, so make sure to have a systematic planning process for tackling the market. Systematic, again, is just saying this is what I'm going to do on a daily basis to plan what I'm going to do, or on a weekly basis to plan what I'm going to do in the markets. You need a target on which to focus in order to accurately and consistently hit your mark. So if you don't have any kind of mark, you don't have any goal or anything, well, you're not going to ever get to where you want to be by just wishful thinking. You need to have a plan, right? And it needs to be specific, and it needs to be sound and scientifically proven. Fortunately, we're proving it. We're proving these things scientifically for you guys. So it's not like you have to actually go back and reinvent the wheel. We're giving you plans. We're giving you strategies and processes that you can follow that are successful. And it doesn't matter what your personality or risk appetite or any of that is. These are systematic things that you can do, that anybody can do, and they will find success with the market. Some may take longer than others, but it's there and it's possible, and it's faster than anyone else can bring you to that point. All right. Analyze in advance. Well, planning a good habit to form is to do fundamentals, which is news, announcements, things like that, and technical, which is lines, support and resistance, trend, Fibonacci, analysis for the week ahead. So after Friday, when the markets close, or during market open on Sundays, are sometimes the best times to analyze for the week. Let's see what John said here. So should you trade at 0.1 for the first 3 months until you get more money through your quarterly review, or try and compound it right away? John, if you want to trade at a 0.1, and that's it, that's fine. The point is that, I mean, honestly, I would recommend compounding even at a 0.1, because you're not taking any additional risk. The idea of trading at a 0.1 is that you don't want to take more risk than you can handle. So trading at a 0.1 with a brand new $2,500 account and then compounding that is the same risk as your account being $2,500 and trading at 0.1, right? But now you're just trading on the additional profit that's within your account. So it's up to you. And the first 3 months, it's not a bad idea. I'm not saying don't do that. I'm saying that at some point you need to break out of that and figure out what your approach is going to be in the market in order to make profit. And the other thing I'm saying is that there are instances sometimes that trading at a 0.1 is not going to save you from insurmountable amounts of drawdown. Trade a 0.1 like you would trade a 10 lot, right? Still keep your exits intact, and don't let your trades go beyond 50 pips without doing something about them. Just because you're at a 0.1 and you can afford to let it go beyond 50 pips, that's a bad habit to create. So keep it within 50 pips, right, or less, preferably less, especially if your win rate is low. If your win rate is low, then you want to make it relative to whatever your win rate is. So again, going back to the calculator, and that's why we have this calculator. Cool, you can trade at a 0.1. So if you have an account, your account free margin is $2,500, and your win rate is 80%. Your risk and your stop is, let's just say your stop, you've identified your stop or your hedge position. Let's say your hedge is 25 pips away. So instead of putting it at 25, you're going to add 10 to it, say 35, because you're going to wait for it to post beyond that hedge level, right? Now, lot size 0.07, okay? Can you even take that trade? No, because you can't put in a 0.07. So if you're saying, well, I'm at a 0.1, so I'm just going to trade everything at a 0.1. Can I trade this at a 0.1? The answer is no. I can't take that trade. If it was at 30, can't take it there. Probably going to be more like 25. Yep. I'd have to have my stop loss or my hedge at 25 strong, not 26, not 27. And then I can trade at a 0.1 lot size. And my minimum take profit with 80%, risking 1% of my account on a $2,500 account, is 8.3 pips. Can I get 8.3 pips? Why? Because at 80%, if I'm taking this same trade 8 out of 10 times, right, then I'm going to make 8.3, 8 out of 10 times, but I'm going to lose 25 2 times, right? So 8.3, let's just use a calculator because my math brain is not working today. So 8.3 times 8, 66.4. Okay? If I had a 25 pip stop 2 times, that's 50 pips. So 63.4 minus 50 is a profit, and that's what you want, of 13.4 pips for 10 trades. So minus $6 for the 60 cents of lot that you use, minus 6, you still have a profit of 7.4 pips. And we say minus because a 0.1 lot size costs you 60 cents to get into the market with. So if we took 10 trades, then 60 cents 10 times is $6. So we minus that, and this is our net profit, 7.4 pips. So if I'm using a 0.1, yeah, I can justify a 0.1 if I'm taking this minimum take profit. But if I'm taking less than that, look at how much space I have, 7.4 pips. So I could maybe take off, I can't even take off a full pip out of 10 trades because that would leave me at a loss. So I would have to, let's just say 10 divided by 7.4. So 0.13. So I could make this 8.2, maybe 8.1 for minimum take profit. So 8 pips flat. That's about as far back as I can go. So I've got to take 8. If I can't see 8, then I don't take it. The best scenario is that you don't just take 8.3. You take 10, 15, 20. And that helps to offset this ratio. And that's how you make more profit. If you're not to that point yet, give yourself time. So to answer your question, John, yeah, trade at a 0.1 when you can justify it based on your win rate. You can break this rule if you want. You're just, do the math. You're not going to be successful. Do the math. It's just not going to work out for you. If you're not taking the minimum take profit, if you're trading at too high a lot size, you're going to risk your account, and you're going to hope that you get lucky. But if you start making those types of habits, it's going to catch up to you, and you're going to lose. You won't be here next year. So to scalp, you got to be at least a 90% win rate to scalp a 3-pip trade. I know this is not what a lot of you guys want to hear because you guys want to be scalpers. But look what happens. If I have a 15-pip stop with a 90% win rate, I have a 3-pip take profit with a 90% win rate. If I have a 25-pip, let's try to get all the way down to 0.1 lot size. So if I have a 25-pip stop loss with a 90% win rate, I have to take a minimum take profit of 5 pips. So now we're getting out of the scalp range, right? If I've got a 30-pip stop loss, now it's 6, right? A 50-pip stop loss, I got to take 10 pips. That's not a scalp anymore. I mean, it might be a scalp during high volume times or in the Widowmaker, but for the most part, you're not going to be able to even do this unless you're at a 90% win rate. Because if I have a 15-pip stop right here and I'm at an 88% win rate, the math doesn't work. Well, the math works there. Sorry, 86% win rate. I have to take at least 3.8. So I've got to cover that spread basically, right? But my lot size decreases pretty exponentially as well. So 80% win rate, I have to take a minimum of 5 pips with a 15-pip stop, which is a 3-to-1, and I can only trade at a 0.17 lot size. What is the best way to improve our win rate? How to get better at identifying winning trades? Brent, that's a great question. We're going to talk about best practices in another session, but I'll tell you the best way to start fixing your win rate right now is to have a plan. Because you guys are panic trading, or you guys are trying to jump in on the price action. Awesome. Good to hear, John. So when it comes to analyzing the market, we learn to justify which trades we're willing to take with which ones we're not based on our risk. And if you stay out of trades that are too risky, then you find yourself not getting in trouble. Now, keep this in mind. You may lose, you may not pick up some winners, right? But to be at an 80% win rate, for every loser, you have to have 8 winners. So put that into perspective. Now, if you start not taking trades and you realize, man, I missed the last 5 trades that would have been profitable and one of them lost. Well, know right there that 5 trades is not enough to offset one loser. It has to be 8 trades to offset one loser in order to be an 80% win rate. 8 trades to offset one loser. 84.4 last week, 90% seems so hard to reach. Brent, you can get there. It's just about tightening up, right? And look at your win rates over a quarter, a month. A week is tough, but if you look at it over a month or over a longer period of time, you're going to get a more consistent number. And by the way, your win rate is only relevant in currency pairs that you have more than 30 trades in. Preferably 50 or more, but 30 trades is the bare minimum. You got to have at least 30 trades in order to work out a win rate. But that's awesome. 84.4, Brent, think about that. The average in the industry is like 60%. 84.4, people are filthy rich, and they're at 70%. So do you really need to have a higher win rate? No, you just have to make sure you're making profit. At 84.4, you can be rich. And along the way, you'll get better. So versus working on how to get your win rate up, just work on how to figure out how to mitigate your losers and how not to take trades that are too risky. 84.4 is phenomenal, unbelievable. If you want to talk to people about having an 84.4% win rate in the day trading industry, they wouldn't believe you. Prove it. I want to see this for myself. Yeah, it's probably because you're trading at a low lot size and you let it draw down until the market returns. Hey, if you show them, look, I'm doing this successfully, I'm making money, they're going to be like, holy cow, where do you drive? Where do you live? You're rich. I want to pick your brain. I'm telling you, Brent, the 84.4, that's a great number. That's awesome. That's something that you can really build on. So I would say don't focus so much on improving that number as much as improving the losers wiping you out, if that's the case. And that may not be the case for you. But if it is, if you notice that you're not growing your account the way you want, then create that foundation. Don't change anything you're doing by identifying trades in the market, unless you're taking risky trades and just letting them draw and hopefully come back. Now, last week we had a lot of consolidation, and so it's tempting to allow a trade to draw against you and then come back because the market kind of stayed sideways. And that's the scary part about recruiting people during times when the markets are sideways, because they get the notion that the market always returns, and it's just not true. All right, let's go back to our slides here. So this is after Friday when the market closes or during market open on Sunday are some of the best times to analyze for the week. This is a great practice to adopt as it gives you an opportunity to process what you are seeing without the pressure of placing a trade. Okay, so if we are analyzing on Friday or after market or Saturday or Sunday before market opens or Sunday when market opens, you're not really considering taking a trade. I think most of you, if you guys trade on Sunday, you're taking the gap trade. Generally, if there is a gap, you really can't read the indicators until about 4 hours after that gap happens, because the 60-minute has to normalize. Sometimes the 240 and the 1 day aren't going to even be normalized, depending on how big that gap is, because it tends to skew and elongate the indicators in one direction, and then they have to correct and then start giving positive and then viable readout. That's why we don't like unnecessary gaps in our charts. So if you are trading the gap, and you've got some type of scientific reason on, I'll be honest with you guys, me personally, I'm not a fan of trading the gap just for the sake of there being a gap. It's just not, there's no scientific method to that. And the statistics aren't high enough for me to justify doing that. To trade a gap, the gap has to be 90+% for me, which means if I get a loser, I have to have 9 winning gap trades in order to offset that losing gap trade. Some of you have never even taken 9 trades in currency pairs that you're trading gaps in, and you have no analysis on them. And so if fundamentals or it takes off in one direction, you have no technical analysis. You're not sure how the indicators react in that particular market. You don't know the volume, volatility. You don't know anything about that market, and you're trading in it. That you're setting yourself up for failure, because it may not happen the first, second, third, fourth, fifth, sixth time. But remember, you need 8 of those trades in order to even have a good win rate, right? So if you don't have 8 of those trades, you don't know anything about that market. Once it starts taking off on you, all it's going to take is one of those to eat your lunch, because you're not going to know what to do. You're going to be in no man's land. You're going to be forced to have to do fundamental analysis on the fly, do technical analysis, figure out what the heck is going on in that country and that market, all on the fly, right? And hopefully by that point you either stop the trade out or you hedged it. But it baffles me why a lot of you guys are taking trades in currency pairs you know nothing about. So again, best practices. We want to make sure that we go through a systematic trading plan to justify what it is that we're doing in the markets. Why can't I see my cursor? There it is. Okay. So let's look at some examples of analyzing in advance. Fundamentals, the how-to for fundamentals. Use more than one source for Forex news and an additional source for other news. So if you guys are just paying attention to Forex news, you're only getting part of the story. And if you're only watching one Forex calendar, you're getting a fraction of the story. Because there are instances where you have announcements in one calendar and not in another. And sometimes those will be impactful. Or one calendar will have an announcement as yellow or an orange, not very impactful, medium impact. And the other calendar will have that same announcement as a high impact, or vice versa, right? So it's good to have both. And if you're not sure which to trust, start reading about them. Start clicking on them and reading about them and becoming familiar with them. You can even go back historically and see what happened in the market historically when those announcements happened. Focus on red announcements primarily, but don't ignore all other announcements. So if you've got red announcements on Forex Factory and Cashback Forex, then you probably want to, focus on that. Read about the announcement. And although you may not understand what it means, do additional research. So if we go to an economic calendar right now, let's just go to forexfactory.com and let's look at announcements today. Fed Chair Powell testifies. This is a good one because people are like, well, what are they testifying about? Who's on trial, right? So click on it. The text of the testimony is due at the release time listed. The testimony is scheduled for delivery 90 minutes later. So you wouldn't know that unless you open this. So that means 6:30, you may not get the reaction. But then, 8 o'clock comes around, all of a sudden you see the market reacting. You're like, holy cow, what's going on? There was an announcement an hour and a half ago. Not right now, that seemed impactful, but why is the market reacting right now? Well, if you clicked on the announcement, you see, well, you actually don't even know what they said until 90 minutes later. Due to testify on semi-annual monetary policy report before the House Financial Service Committee in Washington, D.C. You might not know what any of that means. And who is this person? Federal Chair Jerome Powell. You can click on him and or Google him and find out who he is. This is Federal Reserve. What is the Federal Reserve? This is the latest release. More hawkish than expected is good for currency. Hawkish is good. Hawkish means they're talking positive. Good for currency means that it's good for the U.S. Now, on the Euro-US, that means that the Euro-US, if it reacted the way it's supposed to, and this is good for the currency, the Euro-US would go down if it was hawkish. Dovish is they're talking negatively about the currency or negatively about the topic. So hawkish is good, dovish is bad. Fed Chair February 2018 to 22, Fed Governor May 2012 to 28. The testimony usually comes in two parts. First, he reads a prepared statement, so a text version is made available on the Fed's website at the start. Then the committee will hold a question and answer session. Since the questions are not known beforehand, they can make for some unscripted moments that lead to heavy market volatility. As head of the central bank, which controls short-term interest rates, he has more influence over the nation's currency value than any other person. Traders scrutinize his public engagements as they are often used to drop subtle clues regarding future monetary policy. So in case you guys don't know, Janet Yellen is no longer the Fed chair. It is now Jerome Powell, which was decided last year. So usually this would be Federal Reserve Chair Janet Yellen testifies. But now that Yellen is no longer the Fed chair, Jerome Powell is testifying. And he's due to be the Fed chair until, let's see, well, he was Fed governor from 12 to January 20, and he's scheduled for 2028. Or Fed chair from 18 to 2022. So he's supposed to be Fed chair until 2022. So that's going to be pretty impactful, right? If you don't know what some of this means, or even as they speak and you're reading their text version after they've spoken, you don't know what any of it means, continue to read it. And what you're not sure of, Google it, look it up, try to get some research on it, try to find out, right? CNBC, let's go to CNBC. So yields start jumping right at the moment when Powell hinted at more rate hikes than expected ahead. There you go. So you're reading it right here as well. Let's look at U.S. Dow falls 150 points as Powell signals Fed will keep raising rates to continue inflation. So again, there are two wings of the same bird. There is currency and economy, right? So this is like the financial economic, and currency is the other wing. And sometimes what's good for the currency is not necessarily good for the economy. And sometimes what's good for the economy is not necessarily good for the currency. And other things are good for both, like unemployment. If we have low unemployment, that's good for both economy and currency. And that's one of the few instances where there is one thing that mutually benefits economy and currency. EU, Europe stocks close in the red amid earnings. Powell testimony. See there again, that's why I look at CNBC, because if I didn't know that red announcement was important when I looked at it in Forex Factory, or how impactful it would be, this gives you good insight, because here we are in the financial markets, not the currency markets, and they're talking about Powell here and Powell here in U.S. and Europe. Asia, Nikkei advances 236 points as advanced in Asia stocks pause. Oil prices extend losing, falling in tandem with stock market as interest rates jump. What are they talking about with interest rates? Again, Powell in oil, in U.S., in euro. These are not even Forex announcements. Gold slips ahead of testimony by Fed's Powell. You can see a lot of traders were waiting for this information. Bonds, yields jump after Fed Chair Powell hints at more than 3 hikes this year. And then, of course, foreign exchange. Dollar adds to gains as Fed's Powell nods to gradual rate hikes. I didn't learn this through coaching, guys. I learned to stay away from announcements as a result, or as I'm trading, as a result of coaching. And that was good advice, and I took that advice. But I took it a step further, and I started learning what a lot of this stuff meant, so I know how much of an impact it's going to have. And then I also learned that sometimes it's supposed to have one impact, and it actually has the opposite. But it gives you good insight as to what the markets are doing and how impactful and what traders are waiting for. And a lot of times what traders are waiting for is going to cause consolidation and then one just yank in one direction. Not that we're going to trade it, but we want to be cognizant. If we're in an open trade, then we want to hedge it. If we're considering a trade, we want to hold off. Right? So it's good to know these things. And if you're not sure, again, if you're not sure what any of this means, yields started jumping right at the moment when Powell hinted at more rate hikes than expected. If you don't know what yields are or how they started jumping, click on it, read about it, watch the video, do whatever you have to educate yourself. This is secondary education, and it's free. You don't have to pay for it. You don't have to pay for any of this. This is a secondary education that you can gain and understand how the financial markets work, how each currency like the USDX and other currency is valued. It's valued against a basket of other pairs. Find out what those basket of other pairs are and find out its correlation. It helps. It really does. You don't feel like you're in the dark anymore. So you can do this most of the time starting on Sunday or even Friday of the previous week. There are some instances where you won't see announcements until like 2 days or the day before. So always check these to see if there are any updates before you put in trades. But you can check these and say, okay, I I know that this is coming this week, so I want to see how impactful that's going to be. And start reading about it and learning and understanding, and just, okay, I want to be cognizant of that. I want to make sure that I'm not in a trade, or, you know, if I see consolidation, I know what it could possibly be associated with. And even though it's high volume times of trading around that time, at 5 or 4 o'clock, if I'm in the market Mountain Standard, then I know if there is consolidation, it's a result of traders holding off for Fed Chair Powell to testify. So you're not confused by why the market's not moving in otherwise high volume times, or why an announcement that just happened before that really didn't have a very big impact. So you can do your homework beforehand. And it gives you time to research it, because, again, you're not trading in the market. You're not trying to place a trade. So it's not like you're trying to rush through any of this. You're just taking your time and reading about it and learning and understanding about it. And that way, when the day comes and you're going to trade on that day, you know what type of impact there may very well be on that day. And there are some cases where the market will consolidate for days leading up to major announcements. So be cognizant of that. Read about the announcements, and although you may not understand what it means, do additional research and continue to do that. Eventually, you'll start understanding. Take one rabbit hole and run down it, and it'll lead you to another rabbit hole and go down that one, and so on and so forth. And eventually, you'll start understanding this stuff. If there's a word in there you don't understand, Google it. You know, hawkish as it pertains to the Forex market, and you'll get all kinds of stuff. You'll be able to read dovish as it pertains to the Forex market. You know, whatever. Google's pretty awesome that way. Remember, media outlets always try to spice up the story and make it a bigger deal than what is actual. Don't buy or sell into the rhetoric. So don't let them make you so panicked that you don't put in a trade, or so committed to one direction that you're like, well, every media outlet is saying that the U.S. dollar is going to drop, and so I'm just going to short. The Sunday market open, I'm going to just short. Because if everyone is saying it, that means everybody knows about it. And if everybody knows about it, then the banks know that everybody in their all vast knowledge and knowing are going to do one thing, which gives the banks the opportunity to do the opposite. And who's going to win that fight? Not the small traders. The banks are going to win that fight. So don't do it. Don't try to use it in that way. It's just foolish. Media is often a good contra. Indicate, yeah, that's true. Very often, if we could get 90+% on media saying something and the market doing the opposite, that would be an indicator in and of itself. Technicals, how-to technicals. How do you plan this in advance? Keep your technical analysis simple. If your charts look like the image on the right, you're overcomplicating it. This is a real thing, guys. I took this picture from online. Like, this is how people trade, and they're like, right here in this little, where this one crosses that and that crosses that right there, we're going to squeeze in a trade. And then we're going to write it out, and then we're going to put a stop, and hopefully, you know, it just continues in that direction. We make a whole bunch of profit. Otherwise, it's going to come back and take us out 30% of the time. Otherwise, 70% of the time, we're going to just let that sucker ride. We're going to make a whole bunch of profit. This is, man, they spend days doing this stuff, right? Don't do that to yourself. If you've got too many charts open, you've got too much busyness going on in your charts, simplify it, because you don't understand half that stuff to the level that you should be trading live with it. If you feel like you are proficient with each and every one of those disciplines that you have on your charts, then cool, leave them there if they're working for you. If you are not successful as a professional day trader and you've got a whole bunch of things, you got RSIs and you've got EMAs and you got, you know, stochastics and you got major, minor, pressure and TNT and echo and 15 different time frames, the 1, 3, 5, you know, 15, 30, 60, 120, 240, you know, it's just too much. You don't even have one of those things mastered. You have no business using a whole bunch of other crap. Otherwise, you're just watering down your learning process. You're trying to take in too much, and you haven't mastered even one thing. And here you are trying to master 15 different things simultaneously. It's not going to happen. It's not going to happen. If you're going to master anything, master your exit method. Master your risk. Figuring out what your risk is. Be able to do the numbers in your head, or know what number comes next so you can use a calculator to do it. In the meantime, use the calculator that we have on daytradesmart.com. Use the trading checklist. because regardless of whether or not you get to a point where you don't have to use the calculator that we've provided for you, you're still going to work with a checklist if you want to be successful at this. If using a 60-minute chart, try to keep lines separated around 10 to 30 pips. So 10 to 30 pips of separation. That's, around that. If it's 35, closer to 40, it's okay. If it's, it probably no less than 8, because you don't really give yourself enough range to trade in if you're no less than 8. But, 10 or more. From current market price, have 200 pips of lines above and below. The more, the better. So 200 pips above and below if you're trying to analyze on Friday or Sunday for the week. And then as the week progresses, you can adjust those lines. So let's look at an example here. So let's finish this first. Identify long and short trends and draw in channels. Use fib to identify any possible retracement and see how it coincides with your support and resistance lines. So don't rely on fib. Rely on your support and resistance, and then check fib. Use the day chart to identify major levels of support and resistance. Are there major levels that we're going to run into? Levels that on the day and all the other charts just seem to reject price. Be cognizant of where those levels are. Color code your lines so you know the difference between regular lines and those of significant importance. If I have a major day line, I'm probably not going to make it red or anything else that I use for a hedge or price average level. And I may use a dashed or a dotted, or I may make it thicker, or just so it tells me this line is significant importance, and it's probably not on this chart. It's probably on a different chart. I like analyzing my 240-minute chart for support and resistance, but don't go and do that unless you're confident in your exit method. I don't necessarily need to wait for a post to hedge a trade. I can generally see if the indicators are starting to turn and I missed my trade. Sometimes I'll stop it out early and take the profit, or I'll hedge tight, and then I'll price average out really easily later. If you're not to that level yet, then just use a 60-minute, because that's going to give you a post beyond a support and resistance level that would determine where to hedge. Remember, no one is ever supremely confident in their support and resistance lines, so don't over obsess. So let's look at some of this. And I've set these up, guys, just so you know. So here, I've got a trend. This is current, right? I've got a trend, and this is a 60 minutes, so let me clean this chart. I got about 4 minutes and 37 seconds left on this chart. So I've got a trend, and I've got support and resistance levels. I can see that I touched the trend, came back to the 50, touched the top again, and now I'm digressing. If I go back, I'm tracking this trend from back here, where I can catch a nice little trend. But you can see all this consolidation. We had massive consolidation from here to, I mean, we could even say from like this point right here over to here for 7 days, for a whole week. And then finally today, we broke out of that consolidation. So we kind of went sideways, and as we went sideways, we worked our way back up in this downtrend. And then as soon as we touched the top, we saw this digression, and then we saw the announcements come out, and we saw that strong push down. And now here we are down here on the 78.6 and 76.4 of this trend. So if we're looking at this, and we had this plotted out at the beginning of the week, then we can see that we just broke support, and we were kind of playing back and forth before reaching this bottom level. Now, it could be that we have another level inside here somewhere, right? You can see these lines, there's plenty of them, but from Sunday, market open, let's go here. We have, oh, where's the market open? Right about here. So from Sunday market open, we have a good 260 pips above us and a good 173 pips below us. Plenty of lines. And as the market conditions progress, we can adjust our lines. So are we holding out in those lines? Yeah, those lines are holding. Good. Every time we break a line, we continue to another line. This broke, so we expect to continue. There's our continue. And then we continued, and then we held, came back up, held within these lines. Broke, we expect to continue. We continue to there, and then we wait for a break and continue. Break, we expect it to continue again. It didn't continue right there, so we'd probably add a line, right? This is about 15 pips, not much. We could try to adjust some of these lines if we needed to, or just add a line. We're not going to worry about that right now. We're just kind of giving you an example. You can see again, we were kind of held somewhere in that range. You know, so if we needed to add a line, we could very well try to go back and see if there's something that we missed, or we can adjust these lines at all to compensate for. All right, there's a break, break, continue, break, break, continue, and not a continue yet, pull back, and then that brings us to our current. So right now in 1 minute and 12 seconds, if we break above this line and we don't continue, we could say, okay, can we adjust this down, or can we add another level that we're missing in between some of these two levels right here, which we have about 30 pips of separation. So let's look at that first, right? Let's go back, and this is the line in question right here. So I'm just going to make that one black, and let's go back and see if we have anything. So we see that we definitely had some support there that we broke through, but did we continue to anything? We see right here that we have some levels that we could use for continuation right there, because we hit and then came back up, and then here again hit and came back up. So let's look at this line and see, does that give us at least 10? Yep, that's 14, and that's 16, right? So that line's good. We could use that line. And now I don't have to draw on every single line. I just had to draw on one line. Or I had to go and focus on one line instead of drawing in all my analysis all over again. And look at that. Did we continue that line? The answer is yes, we did continue. So we broke above this line. So suffices to say, if my lines are good and I have a signal, I could likely position down to the support level and then look for a long position up. Do you draw support and resistance on both 240 and 60? Sometimes just a 240, other times 240 and 60. Yes. Those recent lows are a 1.618 fib expansion. Fib has, here are Fibonacci levels. And I know that there are other disciplines that do different things with fib, but here's Fibonacci right here. And 23.6 for that move down is all the way up to 123.073. If we're looking at retracement just for the day, clean chart, then we're looking at this day right here. Actually, that's not true. Sorry. Go to a different chart. This day right here, and that'd be bottom to top. We see we retraced 50% and then broke out of that altogether. If we're doing from this high to that low, to our new low, I guess we'd have to go to our previous low. Then we can see we hit 23.6, nail on the head, and then continue to a new low. Our retracement from this point would be 23.6 to here. And if we retrace just the day, which we still have 3 hours left in this day, but if we looked at retracement for the day, we've already retraced almost 23.6 in the same day. So we went up, high to low, 23.6 is there. That's the only way I use Fibonacci. Okay. So if we're looking at our current and we're saying, okay, we're in a downtrend, we saw that, but when we haven't hit the bottom yet, and we may still have cause for up, then we can look at this and say, okay, does this look like it's going to be strong up? Or does it look like it's going to be momentarily up and then possibly consolidation back to this level before we touch that level and then possibly back down at that point as this trend line moves down towards us as well. So then you start putting weight on which indicators are telling you what you can see as you compare it to your technical analysis as well, right? So let's go look at some examples really quickly. Right here is 5/5/2017. We have support and resistance. Let's see. Is this the, yeah, okay. And we're saying, okay, we've got an uptrend, but we're almost to the top of that uptrend. You can see we trend this from this point, and look at that. It fell right in line, right? Everything's right. Everything's lining up really well. Okay. So when we get to the top, we broke resistance. When we get to the top, we may want to shy away from some of those long trades. So this is Friday. Now, Sunday opens with a gap up and then closes that first 60-minute closing the gap with the indicators looking like this. Now, again, we're not using the indicators for the first 4 hours because a lot of this is a result of the elongation, right? So this candle ended here, major, minor pointed up, but when it started, these were stretched way up. So if I replay this chart from here, play, you'll see what I mean. Market opens, and watch what happens to the indicators. You get that elongation, right? They ended looking like this, and they opened looking like this. Right, vastly overbought. I'm going to back up real quick and speed this up. Okay. So here is your first hour. So we're going to go all the way to the last hour of the 4 hour. And so we're not doing anything until 4 o'clock or 7 p.m. Sunday. So so there's 2 hours, here's 3 hours, and here's 4 hours. So this is 109.754, 109.754. Okay. Now we can see that we've touched the top and we just shot down. We haven't touched that 50% level yet. We technically have determined that we were in an uptrend, right? But we're starting to see some digression down. And if we look at the post on the 240, we can see that we've got, actually we're not going to use that yet because we had a gap, so we're going to look at just the 60. If we're looking at just the 60, then we can see really quickly that we do have potential to see some up, possibly some up, about 9.7 pips with the trend, right? And if we're taking this trade with the trend, and we can see that it's soft, it's not very strong quite yet, pressure is against us, minors are crossed up, majors are also crossed up and hanging back, so we almost have this head fake scenario. We may not want to put any weight into the long. And if we do, then we only want to take like 50% of that, so maybe 5 pips, if that. But because of the head fake, we may even want to take less than that, if at all, right? We're not using the 240. We're maybe looking at a 5-minute for positioning, and our 5-minute looks vastly overbought already. 109.754, 109.754. This is the 5-minute, and you can see that on the previous 5-minute post, kind of had that hiccup pattern, and with the exception of pressure. And again, majors are more dominant, the 10 to 15 minutes before the top and 10 to 15 minutes after the top of the hour. So we can see that majors are probably going to have their way here because this is 5 minutes before the top of the hour. And they do. They have that pull up, right? Now you got that vast overbought. which gives you a nice opportunity to position short if you were going to position short. We do have a head fake here. We have pressure in our favor, contrary candle. Minors have entered the channel. Majors are also crossed. So if we're planning on this head fake, then we're actually looking at a short, right? And a short gives us about 26.7 pips or 26.2 pips to the support level below us, but we're only taking 25% of that because we're still against the trend. Okay, so if we're taking 25% of that, then we're only looking at about 6.5 pips, 6 1/3, 6.3 pips or so. So if we're using our calculator, then we're saying, okay, where's our exit? So our exit is going to be, let's say our exit is going to be right here, about 24, so that's going to put us about 34 pips away. Let's say we have an 85% win rate. So this is going to be about 34 once we hedge. Let's say we got an 85. I've got a 96, but let's just say 85% win rate. We only have a $2,500 account, and we're going to put in a 0.15 for a minimum of 8.5 pips. Can we get 8.5 pips? We're justifying. We have about 26, and we know that about 6 of those is about 25%. Can we stretch it and say 8.5? Let's go for it. 8.5 pips, and from this position, so make that one pink, that's our entry, and then 754, so we're going to go to 669, 669, and we're going to actually take this to 657 because that's going to account for spread. We're going to set our take profit at 669, but we're going to measure to 657. So that means that we've got to go and retrace this whole candle, and that's about 9 point whatever pips, right? All right. So our analysis right now is saying, although this is soft, because this is soft, but we're in an uptrend, but we've already, the 5 minutes is already pretty positioned. We're just going to go ahead and go with a short, but we're going to cover our tail pretty quickly. And so if we go beyond this level, then we're just going to hedge it, and then we're going to deal with it later. So we're only using a 60-minute because we can't use our 240 yet. So there's 60 minutes, and in the first 60 minutes, we get that push up. Let's see what happened with the 5 minute, by the way. So the first 5 minute, we got a digression because that's what we thought. We expect to see some follow through. We don't get much follow through, and then we get a pull up, and then a pull down, and another pull up, and then there is, let's see, 8. So we know that this goes a little higher. There's 797. There's 821, and then after that we start to pull down. So in terms of positioning, we missed about 7.4 pips of positioning, but nonetheless, it's not enough to really be concerned about quite yet, right? And we can see that this is now starting to soften even more than it was before. Minors have pretty much ran away, and majors are still kind of hanging back. And then we get our trade. So there's our trade. Could we have gotten 8 pips long? No. So we picked the initial 8 pip direction. What we were using was just what we could count on. Did we even look at the TNTs? No, we just looked at major, minor, and pressure. And then we used the calculator to determine how many lots we're going to put in for that trade based on where our exits would be and how many pips we needed to justify taking based on our exit. And had we not gotten it on the previous candle, we would have gotten it on that candle. And then because we're still kind of in that uptrend, we did get that push, right, long, in spite of the fact that these looked soft. So another thing to identify is when the indicators look like they're soft in one direction. So let's go to a place where we kind of break out of this trend. All right, so right here, let's look at this example. We can see that, let me clean this up. So right here we can see we've kind of switched. Even though we're in this uptrend, we touched the top, and now we're kind of gunning for the bottom of this uptrend, which means long term we have an up, right? And short term we kind of have this down push right here. Right there. Which one is more beneficial to us right now? They both look like they are for a couple of reasons. First of all, the down, we can see that we haven't completed that push all the way down to this blue line down here for the trend, or the uptrend, sorry. And the down is showing us that we're kind of at that 50%, which also coincides with this major support level that's been holding us for a little while. But for the most part, we've been in this down for quite some time now. And we haven't touched the bottom yet. So let's go to our indicators. Right here, we've got with the trend, there's some separation between major, or not with trends, kind of with the short-term trend against the long-term trend. We've got separation between major and minor, and we've got green on top, but it's starting to lean into red, which generally means you're going to kind of get that pop below, right? And so when you're looking at this, are we looking at the shorter term holding more weight right now than the longer term? And the answer would be yes, because in the longer term, we're still gunning for the bottom of that longer term. And in the shorter term, we have a downtrend that's telling us we're still consistent in that direction. But we're not ignoring the fact that we have a longer term trend. Are we taking the trade right here, 1.4 pips to the next level of support? If we are, then we're counting on it going beyond that to the following level of support, which is about 20 pips away. And if we're using this short-term trend, then we can justify 10 pips in our direction. Is this enough to give you confidence for a 10-pip trade? That's the question, right? So let's associate that with risk. Right here is about 10. That's about 25 pips. So let's say 35 pip hedge or stop. So let's go here. And 35, that means that we're going to use a 0.14, and we're going to get at least 8.8 pips. We said that we can get 10 if we go to this level. So 10 is greater than 8.8, so we're going to go for 10 at this level, and we're going to stop this or hedge it, about in this range, about 10 pips beyond that if and after it posts above that. Plus, it would be outside of this downward channel right here. So it's a great place. It's an awesome place to have that hedge and potential price average, especially because we're looking at, or not price average, but hedge position, especially because we're looking at if we do go that direction, we are with the long-term up, and so it's likely it'll continue in that direction. But let's see what we can do with this shorter-term read using just the 60. Knowing that we don't have a lot of strength here, major and minor are separated, but it is going with the short-term and even in favor of the long-term digression of the long-term uptrend. So this line right here is going to be our entry. And we're going to go 10 from here, 109.247, so 147, and we're going to go to 135 for measurement sake, 35. Because 147 would be our take profit, but the market would have to move to 135 to cover our 1.2 pip spread. Okay, so let's go forward, and we get it right away. Because we're using the force of the trend, both long and short, and we're using our calculator to determine the risk, and we identified that the risk was such that we could take it because we said we could get 10 and we only needed 8.8. And so 10 is going to be optimal. We get our 10, and we didn't over-risk our account because we didn't use a higher lot size than we needed to. Nor did we just use a 0.1. Erase. Okay. Now we are in that short-term down, but we've touched the bottom of the long-term down or the long-term up. So unless we break that, we want to be really cognizant of our indications. So let's go to the next example. Right here, we saw a lot of down, right? We saw that there's a lot of cause for down still, even though we've kind of touched the bottom of that channel and then we bounce back up, right? So this indication right here, we got majors crossed up, minors crossed up, green is on bottom and sideways. If we're just using those, how much weight are we going to put into this candle immediately after this? Probably not much. Either we get in at the bottom down here or we wait. But right here, we're not going to want to put too much weight on what looks to be a good buy opportunity, because we've seen that we've pushed down quite a bit, and now all of a sudden we get this quick run up, which sometimes will give you the indication, okay, now it's time to change directions, right, and start going back up. We touched the bottom of that channel. So either you do nothing or you're cautious about your long trade here. So because we're still considering this counter trend, we've got 11. Let's just say we are with long-term trend. So let's just say 5 pips long, right? I want to show you guys how some of this works out, because I'm hoping that it saves you guys sometimes. And I'm going to do my best to explain it, because there's a lot of nuance here. So please ask questions if you're not sure. So we can see, okay, we've got a lot going for us. We actually broke resistance a little bit. We've got about 11 pips to the next level, so we got 5 pips. Our exit would be right here. Look at this. This is beautiful. 18.7 and outside of the long-term trend. So 28 would put us right to the bottom of the short-term trend. So 28 pips for a hedge about. If we're saying that this line is the hedge position, then 10 pips beyond it, just as a guesstimate, would be 28 pips. So if we said 28 pips right here, let's just say a solid 30 pips right there with the 85% win rate. We're trading at a 0.17, and we need to take at least 7.5 pips. Do we have 7.5 pips? We've already said that 5 is risky. 7.5 is pushing it. But let's go for it. I wouldn't, but let's go for it. So here's our entry. 109.241 and 109.7.5 is going to be 109.316, right? 316 would be 7.5 pips, but let's go 1.2 beyond that for measure. So 316 is going to be 328. That's how far the market has to move, but we know our take profit is set at 316, but the market's not going to get us out at 316 until it moves to 328. Okay, so there's our exit. That puts us really close to the tops of some of those ranges, plus it's still kind of against what we've identified as being this downtrend with minor pullback here. That pullback basically just took us to the bottom of this this consolidation right here. So it's not really, it's not as consistent or as credible as we'd like for it to be, even though it may look that way. And we're not even looking at our 240, which by this time we could look at, by the way. But we're not even looking at our 240. Had we been looking at our 240, we would have seen some pretty obvious things. Let's go back and analyze our 240 really quickly. Look at this 240, guys. We're probably not going to trust that for very much up. Maybe small up because green just popped on top, but minors already entered the channel, and majors are still hanging back. So we may get some small up, but what we're likely to see first is these major and minor come down, and until they agree, both of them agree down, major cross down, minor cross down, we're not looking for an up yet. Not a significant up. Okay. All right, so right here, because of our read on our 240, we wouldn't even be looking for a significant up. So this right here just basically brought us back into this range that we were in prior, but we're not counting on that quite yet. Although we decided we're going to take this trade. Even if it works out, I wouldn't have taken it, even if it works out. So what about this, then what is it that I'm seeing that some of you guys are not seeing about this particular setup and scenario? What is it why is it that I'm not comfortable taking a buy here, even though I can see I broke resistance, Majors and minors are crossed and pointed up. And I even got TNTs, 1, 2. I got thick orange and thin orange pointed up. Blue dotted looks like it might be rolling. Thick blue is pointed up. So what is it that I'm seeing here that some of you guys might not be seeing? There's actually a couple things. One of them is the time of day. This is 7 o'clock. 7 o'clock UTC is midnight, right? What happens at midnight and 1 o'clock and 2 o'clock? British pound open. We see announcements. So a lot of times things like this that are abrupt and sometimes what seems to be unnatural, tends to have retracement. And so a lot of this could just be reaction to the market open and things like that. Were we due for some buyback? Yeah, because we're oversold. Well, now we got it. But in addition to that, we've got our short term telling us we're not quite done. Our long term saying, well, we've touched that level, we've given it back, but our long term still has the rest of the day to finish out within this range, which means our short terms can still go beyond that and come down and touch this short term and then bounce back before the end of the day and just leave a wick or shadow beneath this trend line on a longer term chart. So right here, and even this, or rather this retracement right here is where a lot of us end up getting into situations where it leaves us kind of perplexed, like, okay, couldn't see that coming, indicators are just not right. Well, it's not necessarily that the indicators are not right. It's just that we were putting too much weight on an indication, more weight than was necessary. But because we had our full analysis, and our full analysis was saying err on the side of caution, maybe we sit that one out, and maybe we say, okay, let's give ourselves reasons to continue to short. And that's why some of you guys might be perplexed when I say, I'm going to go long, and you guys are like, holy cow, the markets went short for the last, 5 candles. Why are you going to go long? It's because I'm picking up on something that you guys may not be, but I want for you guys to get to the level where you are picking up on those things. So these things are not getting you in trouble. And there's some nuances within the pressure indicator that can really help that. When you see certain things in the major and minor happen, and time of day and your other technical analysis and fundamental analysis will really give you clue and insight as to what's going to happen in the market next and make you much more proficient. And in situations like this, you may be wrong. It may go up and it may have taken you out in profit. But remember, you need 8 of those to happen in your favor in order to justify one not happening in your favor, to just have an 80% win rate. And the one that doesn't work out, if you're not getting 8 of them happening the way you think, then you're saving yourself trouble by missing the 1 and 2 every once in a while. Because right here, your drawdown is now 18.8, almost to where we would have considered a hedge position. And then right there, you're probably hedging because it did break below that line. Even though it may very well come back after that, you're considering, you're probably hedging right there. If you're doing what's right, you're probably going to want to throw in a hedge, even though you can see that it's kind of holding off there. But we weren't done challenging that line yet. Okay, so let's try to look at another couple examples here. So now we're at the bottom of this channel, this trend line. We haven't touched the support level below us yet, but I want to show you some examples of what would constitute soft and strong. Okay, right here, you can see that this looks strong again. Strong in major minor are when they're together and they're straight, right? And this is 1. So 1 is going to put us at 12, 11, 10, 9, 8, 7, 6 a.m., somewhere around there. So this is U.S. market open. We did touch the bottom of this channel. We're starting to pull back up. Now, if we were going to take this as a signal up, we can see that we have 9.3 pips above us against the trend. Even though we're at the bottom of this trend, So against the trend, but with the regression of the down, because we've touched the bottom and we've now passed through the bottom of that up, which a lot of times we'll use as resistance, and we've touched the bottom of the down here. And we've got major minor pointed up. Green is on top. It's pointed against us, but it's favorable in our direction. Nonetheless, we would have to use this as a counter trend. So 9 pips, so that would give us 25% of that would be less than 3 pips. So let's just say 3 pips. Let's venture for 3 pips. 3 pips, which means, and our hedge, that's about 17, 18 pips like before, so 28. If we hedge there, it would be beyond that line, so it would be 20. Let's just add another 10 to that, so let's say 28 pips. Let's just round it up to 30. No, let's go 28. We're going to need all we can get. 28, we're at an 85% win rate, $2,500 account, risk is 2, 0.18, and we need to take 7 pips. Can we take 7 out of 9 right here? No, heck no. Even if we get it, we don't take it right there. This is not enough to justify 7 out of 9 pips against the trend just because major minor lines are close together. Could we get some buy out of this? Yeah, but it may be 1, 3, or less pips. Pressure is still against us. Green is on top, and that's why we're seeing that digression and a lot more wick and shadow, but we're not going to put 7 out of 9 pips against the trend on the line for this indication. So even though this looks strong against the trend, it becomes weaker, especially because we don't have any other forms of validation. Even if it works. Would it have worked? Yep, we would have got 10 points. There's 10.6. We would have gotten it, but we weren't trying to test our fate right there, right? Because even though it looks strong, we couldn't justify it with our risk. So we sit it out. So sometimes they're going to work out. But if they work out, in order to have an 80% win rate, they have to work out 8 out of 10 times. Otherwise, the time that it doesn't work out and you haven't justified it, it's going to cost you. It's going to cost you profit that you made prior. It's going to cost you possibly, more profit and capital. And if you make a habit of doing that, then you're going to see that every time it happens not in your favor, it's going to hurt compounded. Because even if it only happens, even if you can catch 5 winners and those 5 losers are still on the table out of 10 trades, if you get concurrent losers, then you're just digging out. And maybe do that one in demo. Maybe not. Maybe in a demo account where you're just kind of playing with things theoretically. But you can see, again, best practices is all of this analysis and then using that analysis and not just saying, well, I want to buy, and so I get a little indication that it's going to buy, so I'm going to buy. If trend is against you, pressure is not necessarily fully in your favor, and TNTs are major minors are in your favor, you want to treat these tread lightly here, right? And say, okay, I'm only going to take 25% of this distance, and then figure out your risk. Can I even take 20? Is 25 even enough to justify the risk? And if the answer is no, don't take the trade. Sometimes you're going to win them. Sometimes you would have won them. Sometimes you would have lost them. But it's better to just sit them out. And if you are going to sit them out, don't just sit them out and do nothing. If you think the market is going to sell and that's why you're not buying, look for a reason to sell. So say, okay, well, I may not take the trade to the buy side there, but if it does get there, I may consider selling at that point. What cause would I have to sell at that point? And then start giving yourself reasons to look for, sell opportunities in that range. Is there anything that I could use to justify a short trade once it gets to that level? And if there is, then use it and execute with it. And usually it's waiting until you actually get to that level to even make that determination. Sometimes when you get to that level, you're not ready to make that determination. Okay, let's look for another example here of okay. So right here's a good example. We've validated this down, and we could probably make some adjustments clean chart, because as time progresses, you need adjustments on your support and resistance levels. You need adjustments on your trend level. You know, there may be a number of things that we can make adjustments for. So you see right here that we probably have a level that we may not have accounted for, right? We've got about 21. So if we cut that in half, we'll still have 10 pips. And right here, right about there, we can see that we've got good resistance, and as we broke below, we continued, broke above. We didn't get any continue there, and so we may want to compensate with a level there at some point, perhaps, you know, even now, if it doesn't shorten up our range too much. That's 6 pips, not going to use it. Even though it's probably valid, I'm not going to use it either. I'm going to adjust this line up like this, or I'm just not going to use that range. If I adjust this line, you can see we kind of run into a problem down here, but even where the line currently is, we run into a problem. We came down, didn't continue to anything, and then popped back up. So we can adjust this line. Let's adjust this line. Let's see, can we adjust it to there? Yeah, we'll adjust it to there. That's going to give us 14 pips. We don't have anything there, and we're just going to have to deal with it. We're not going to use anything there. Then we probably need something in here, and there's about 23 pips there. So let's see, we've got these levels right here that we could possibly use, and they pick up right here as well, and right here. So we got validation for that level. So we use that level. Okay. And then our trend, we can probably adjust our trend a little bit as well. Our tops look okay. Our bottoms are starting to look a little wonky. So let's pull that out and pull this in at all. Let's try to catch that line right there. Yep, we can use that. Okay, so now we've adjusted for both support and resistance, and now our channel. Okay. So right here, we can see that we have major, minor. They moved soft up the channel. Now consider this down took 2 candles. Boom. This up has taken 1, 2, 3, 4, 5 candles to just do about 50% of what these 2 candles did going down. That's why this is soft. You see the separation between major and minor? This is not a head fake because green's on top. Still really soft. Still soft. Now soft is relative, right? Because we moved up 15.7 pips. That's enough to get some trading in, right? And now we've broken resistance, so we're working towards our next level of resistance, and we're still soft. Now we're still in this down, but we've touched the bottom of this down after our adjustment, and our top is still way up here, where our resistance line is as well. And we've made adjustments to our support and resistance. We got about 10.4 pips against the trend, so we could probably justify 3 pips, but we know that this is soft. So if this is soft, we may want to instead plan to take a short trade as the market moves up. And so picking that is sometimes tricky, because if you pick a level that's too far, you may not ever get there. Okay, so if we're going to follow, say, the channel, then we can see that this channel is likely to intersect somewhere in the 108.960, and we're probably not going to get beyond that with these soft-looking indicators. So there's 2 choices. We could very well just say, well, it's soft. We kind of got this 4-way happening. You know, maybe we just want to short and go for 5 pips short with the 4-way. It's not exactly 4-way because minors are crossed and pointed down, but let's just let's use it as a 4-way. The other option is to wait to position with the shorter term chart, like a 5-minute, and where your 5-minute is pretty much pointed down right now. We probably don't want to try to take a trade until it's pulled up a little bit. But let's look at both scenarios. Let's say we're going to short from this point. even though we have our resistance level we haven't touched, we're only looking for 5 short. We're not going to put anything to the long side, although the best bet would be to position first somewhere within this green line up here to short. And ideally it would be when the 5-minute is vastly overbought. And so we'll look at that, or we'll also look at shorting from this point right here. So short there, and we're only going to go for 5 pips, 108.862, 108.812, and so we're going to go to 108.800 to compensate for our spread. Otherwise, we want to use our 5-minute to position to short for possibly more than that. Depending on where our 5-minute is, we can justify, you know, if we're going to this bottom, we can justify 10, you know, because about 30, actually about 7 pips short. If we position a little, we're probably not trying to take anything long unless it's a quick scalp with justification. And we do have some justification on the 5-minute that it'll pull back, but again, we probably want to position with that as well. All right, so we're either going to short from this point, or we're going to wait for the 5-minute to overbuy. So we're going to work the 5-minute first. So this is showing the 1 hour after the 1 hour. This is just 5 minutes into this candle. We did get some short first, right? So we would have positioned for a long with the 5-minute short, right? And then came back up. We did touch that line, but we're waiting to position. If we're shorting from this point, because we have a soft indication, we are 11 pips. We gone 11 pips upside down. We're about 8 pips upside down to this point. But we're still waiting for that orange line. We almost got it. We went about 4 pips and then pulled back up. So we're going to wait for our 5-minute to overbuy. And I'm going to show you not just overbuy, but I wanted to kind of fake out the miners first and then recommit to the buy. Green just popped on top. Let's see, we are 30 minutes into this, so miners still have some sway over majors. And there's some follow through there. So we want to see this is a good sign. So now we want to see we're at about 40 minutes, so we're getting into the point where the majors are going to start taking over. And when we see this recommitment, we don't want to see majors leave the overbought before we position our trade. So we want majors to stay here and kind of fake out the miners and majors kind of overbuy. Otherwise, we tend to miss our positioning a little bit. All right, let's wait right here. That's where we'd do it. Majors pointed up, miners pointed up. That's where we'd look for a short if we were going to look for a short. And, you know, we said 108.958. Pretty close to 967, which is where we topped off here. And then we said 7 short, so 108.958. So we're going to go to 108.888. And we're going to go to 7.6 to compensate for spread. We're not going to go to, well, it needs to go to 7.6 in terms of measurement. Okay, so this is our exit for our positioned trade, and this is our exit for our original trade. Now, it doesn't necessarily mean that either of these are going to work out. We're banking on the fact that this was a soft move up. So let's see what happens. So still some drawdown there, right? About 2.4 pips. And there's another opportunity for entry right there. So even though we entered already, had we not, we would have gotten another opportunity. Major, minor both pointed up. And then here's a more promising move. Some more drawdown there and there. And more drawdown, look at that. We didn't go more than about 3 or 4 pips upside down to the long side. This is probably the highest point right there. Nope, 1.6. Maybe no more than 2 or 3 pips. And profit. So there's our profit. we're still in this other trade that we wanted to, or where was it? Oh, it's right here. So we're still in this one, right? We've gotten out of that, the other one. It took a while, regardless. The direction initially was definitely up, but it was soft. And so after we had that intersection, which happened right here, we started second guessing this up push. And although it still took us up for a little bit, 11 pips, 12 pips, had we positioned, we would have had a better entry. Nonetheless, eventually we get our fill. And it happens all at once. Now, why did we consolidate right here, though? And why did we start pushing in spite of there being this soft movement right here? Because, again, you want to be cognizant of the time frame in which you're trading. So, be mindful, and I haven't got to this slide yet, but be mindful of the time frame with which you are looking at the time of day, and the time of day. So we're looking at a 60-minute at 2200, which is after 3 o'clock. What does the market tend to do? Miners tend to take over a little more aggressively on the Euro-US, and we tend to consolidate. So that may look big and scary, but think about it. Look at how much we moved down in 2 candles, and now 1, 2, 3, 4, 5, 6 candles it took just to undo those 2 candles. This is soft. And so our bet was still short, and we never had to hedge, and then we consolidated kind of like we expected to. Now here, this could also be constituted as short because there's that separation. Except for that, our long-term and our short-term are still saying down. Or our short-term is saying down. Our long-term, we broke out of our up. So that in and of itself justifies a down as well. So here, even though this looks soft, it's actually strengthened by the fact that we're with the trend. We've had this consistent move up, and we have met the top of that short-term trend. So we're the end of this soft move up, which means we're going to get a stronger move down. And it doesn't happen until about 3 hours, 4 hours later, and then even more so after that. So it was soft, right, because we saw that up and down here. But what was the overall direction nonetheless? Down. So we still kind of played up to 4.9 pips upside down, and then we took profit. So this will give you insight as to why we take some trades sometimes on it the way we do, is because we're looking at what previously happened as it compares to what may very well happen and the time of day. That's the part I struggle with, because a signal like this during high volume times means I'm going to get like 10 pips short on the next candle within 10 minutes. But low volume and miners being more pushing their weight around a little more after hours results in some different occurrences within the market. Okay, I'm going to finish up this slide and we're going to wrap up for the day. Why do I keep on losing my mouse? Okay, use only that which you are familiar. That with which you are familiar. We just use major, minor, and pressure because I know everybody is familiar with that. We just use a 60-minute, maybe a glance at a 240, and a 5-minute, because most of you guys are aware of how those work. A 5-minute, again, we were cognizant of the time in which we were using the 5-minute, and the 60-minute, we were cognizant of the time in which we were using it, time of day. The 5-minute, the time within the hour, the 60-minute, the time within the day. If we're not familiar with any of that, then we only use that with which we are familiar. Most of you guys might not know what this is. This is a call put indicator. And most of you guys probably don't know how to use it. But I see this on some of your charts. I'm like, dude, you don't know how to use that. Why do you even look at that? Well, because my coach told me, or this person did this one thing this one time, and you know, it was valuable because it worked. Okay, well, there's no science in why you're using that, because it worked for that person. Doesn't mean it's going to work for you. They probably see something there because they're familiar enough with it that they can use it to that advantage. But if you're not to that point, practice it, study it, and then use it in the live market. Otherwise, don't touch it. Don't use it. Just practice it. Just practice with it. In the live market, don't use it. Correlate what you see in the indicators with your other analysis. So we try to do that, right? We looked at our support and resistance. We looked at our channel. We looked at the indication and decided, is this strong enough given the other circumstances to justify taking it in the direction it is pointing? What time of day is it? Are there announcements happening? So on and so forth. Predetermine what constitutes strong versus soft indication. If we're in a downtrend, then a major minor moving up the channel separated is soft, and it's probably not going to last very long. Wait for a positioning on perhaps a 5-minute to short. If it's moving a separate, major minor moving separate down, and it's a downtrend, that may be a little stronger. It doesn't mean it's going to just fire off and go really heavy in that direction, but it's going to be a little stronger because it does have the weight of the trend working in its favor as well. So look for the very next level of support or resistance, and then look for a very tight, or you can be a little more lenient with your hedge or stop position, but also make sure that you are taking the necessary take profit based on your win rate for the stop that you're using or the hedge position that you're using. Back test your theories often. Whatever your theories are, whatever you think that you might see in the indicators and you don't understand, go and back test. Go and find examples of that happened and see if you can bring up enough examples over the course of years that either support or disagree with what your theory is, or show you what it means if you don't know what it means to begin with. Be mindful of the time frame with which you are looking and the time of day. We talked about that one already, and how the 60-minute, we were mindful of the fact that it was after 3 o'clock and the market tends to consolidate and the miners are a little more pushy during that time. All right, guys, we're going to wrap up with that. I appreciate your time and attention. I realize we went pretty far in today, and there are a lot of dots that we need to connect therein. And whatever questions you guys have or formulate between now and our next session, feel free to reach out and ask, because I want you guys to start understanding how these indicators work on a very nuanced level, so that you guys can get your win rates up, but practice a lot of this in the meantime. All right, I appreciate you guys, and I look forward to talking with you guys tomorrow. You guys are very welcome. Thank you.